Welcome back to part 2 of our cash flow statement series. In part 1, we looked at operating cash flow, the lifeblood of the business. Now let's move on to cash flow from investing activities. Just to recap, there are three main components of cash flow statement you need to understand. Cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now let's talk about cash flow from investing activities. This is basically the money moving in or out of business because of long-term investment. For example, when a company sells an asset, that cash coming in. On the flip side, when they buy new equipment, invest in building, or even purchase software, that's the cash going out. So investing cash flow is all about tracking those bigger long-term moves that shapes the future of the business. In short, this section shows how a company spends or earns cash from investment activities like buying a new equipment, acquiring another business, or selling of assets. If net cash flow from investing activities is positive, it usually means the company is selling assets or pulling money out of investment. That could be sign they are downsizing or raising cash quickly. On the other hand, if net cash flow from investing activity is negative, it often means the company is reinvesting in buying equipment, expanding operations, or acquiring new businesses. That can be a good sign of growth, but you need to check whether it's sustainable. So investing cash flow gives us insight whether the company is positioning itself for the future growth or reducing its asset base. That's the wrap up of part 2 of our cash flow statement series. In the next part, we'll move on to cash flow from financing activities, how company raise capital or repay it. Stay finwise with Emma.